Listen closely, because what I'm about to tell you is unfolding in real time, and most people have absolutely no idea what's coming. While Americans were celebrating Christmas, opening presents, and enjoying time with family, something extraordinary happened halfway around the world. Something that's going to change everything when Western markets open on Monday, December 30th. Silver hit $80 per ounce in China. Let me say that again, because I need you to understand the magnitude of this moment. Physical silver, not paper contracts, not futures, not some derivative, actual, deliverable, hold it in your hand silver traded at $80 per ounce on the Shanghai Gold Exchange. Meanwhile, back in the United States, COMEX silver futures closed around $71. That's an $8 spread, an $8 premium for physical metal in China. $8 might not sound like much until you realize this represents roughly an 11% premium. In the history of precious metals markets, we have never seen anything like this. The arbitrage mechanism that's supposed to equalize prices across global markets has completely broken down. And when I say completely, I mean the entire foundation of how silver has been priced for decades is cracking right before our eyes. The setup, how we got here. To understand why Monday is going to be absolutely historic, you need to understand what's been building for months. This isn't some random price spike. This is the culmination of structural forces that have been compressing like a coiled spring, and that spring is about to release with devastating force. China accounts for more than half of global industrial silver demand. More than half. They're not buying silver to stick it in a vault and look at it. They're consuming it permanently. Solar panels, electric vehicles, electronics, military applications, all of these technologies require silver, and China is manufacturing them at unprecedented scale. The Silver Institute reported that industrial silver demand hit 680 million ounces in 2024 and remained near 700 million ounces throughout 2025. But here's the problem. There isn't enough silver to meet that demand. The global silver market has been running a deficit for 5 consecutive years. Let me emphasize that. 5 straight years where the world consumed more silver than it produced. The shortfall in 2025 alone was estimated at around 149 million ounces. Think about what that means. Every year, the world needs more silver than the world produces. So where's it coming from? Existing stockpiles, vaults, exchange inventories, and those inventories have been bleeding out, draining away month after month, year after year. The premium explosion. On December 24th, 2025, Christmas Eve, the Shanghai Gold Exchange closed with physical silver at $78.49 per ounce. By Christmas Day, it pushed toward $80. At the exact same time, COMEX futures were trading around $71.87. This $8 premium isn't just unprecedented. It's impossible to sustain under normal market conditions. Under normal conditions, arbitrageurs would immediately buy silver in New York, ship it to Shanghai, and collect that $8 difference. They do it by the thousands of ounces, by the millions of ounces until the prices converge, but they can't. Do you understand what I'm telling you? They physically cannot do it because there isn't enough available silver to arbitrage. The London Bullion Market Association vaults, which historically held the buffer inventory to smooth out these price differences, have been depleted after years of outflows to meet Asian and Indian demand. Reports indicate that the LBMA free float, the actual physical silver available for immediate delivery, is razor thin. When markets can't arbitrage a price difference this large, it means one thing and one thing only: physical shortage, not theoretical shortage, not future shortage. Right now, today, shortage. The backwardation signal. Here's where it gets even more alarming. Silver in China has moved into backwardation. For those who don't follow commodity markets closely, let me explain what this means and why it's such a massive red flag. Normally, future delivery prices are higher than spot prices. This makes sense. If you want silver delivered 3 months from now instead of today, you pay a slight premium because someone has to store it, insure it, and tie up capital. That's called contango, and it's the natural state of commodity markets. Backwardation is the opposite. It means the immediate delivery price is higher than future prices. It means people are willing to pay more to have silver right now than to have it later. It's a distress signal. It screams, we need this metal immediately and we don't care what it costs. China's silver market entered backwardation even with a $7 premium to COMEX. Think about the desperation that implies. Chinese buyers are paying a massive premium over Western prices and still bidding up spot over futures because they need physical metal now. The impossible choice. This brings us to Monday. This brings us to the gap. When Asian markets opened for the week, they found silver at $80 in Shanghai and $71 in New York. When COMEX opens on Monday morning, traders and market makers face an impossible choice. Choice 1, ignore Shanghai. Keep COMEX prices around $71 and pretend the $8 premium doesn't exist. Flood the market with paper contracts. sell thousands of ounces worth of contracts you don't actually have, and try to suppress the price through sheer volume of synthetic selling. If they choose this path, here's what happens. COMEX becomes irrelevant. The London Bullion Market Association FIX becomes irrelevant. The entire Western price-setting mechanism becomes irrelevant. Global buyers will simply migrate to Shanghai as their price reference, because that's where real, physical metal actually trades. The world will wake up and realize that COMEX prices were never real. They were just paper promises backed by a fraction of the metal they claim to represent. How long can a benchmark survive when the world stops using it to settle actual transactions? How long can you maintain credibility when your quoted price is 11% below where physical metal trades? Choice 2. Let the gap close. Allow COMEX silver to jump toward Shanghai's price. Allow futures to gap up $8 or $10 on Monday's open to reflect the physical reality. If they choose this path, here's what happens. Absolute chaos in the derivatives market. Silver isn't just held by small retail investors and coin collectors. It's embedded in massive hedging books at bullion banks. It's part of complex swap arrangements. It's levered and cross-collateralized across the entire financial system. An $8 move in silver might sound modest until you multiply it across the entire paper market. Margin calls, emergency hedging, forced liquidations, and most importantly, delivery failures. And when price gaps higher, every entity that sold silver they didn't have suddenly faces the terrifying prospect that someone might actually demand delivery. What happens when counterparties realize there was never enough silver behind all those paper promises? The evidence is everywhere. The signs of system stress aren't subtle. They're flashing red across every metric. Shanghai's persistent premium has existed for weeks, not days. The premium that arbitrage was supposed to fix in minutes has stubbornly refused to close. December 26 saw Chinese prices hit all-time record highs. One day earlier, global spot silver hit $75 for the first time ever, extending a rally that's pushed prices up more than 120% in 2025 alone. The Shanghai Futures Exchange has reported declining warehouse stocks. The Shanghai Gold Exchange vault levels show the same pattern. This isn't inventory rotation, it's inventory depletion. Defense spending related to ongoing conflicts in Ukraine and the Middle East has increased silver demand for military electronics and munitions. Unlike investment silver that might eventually return to market, military-consumed silver is gone forever. China recently signaled it may implement new export restrictions on silver, potentially taking effect within days. If China restricts silver exports while simultaneously running a massive import deficit, where exactly does the rest of the world plan to source its silver? The Monday opening. Here's what I expect when markets open Monday morning. I expect volatility unlike anything we've seen in precious metals in decades. I expect gap-ups. I expect trading halts. I expect confused commentary from mainstream financial media trying to explain something they fundamentally don't understand. The recent pattern has been exactly this. Markets open Monday during Asian trading hours with significant gap-ups, and bullish momentum continues throughout the week. Gold has been moving 1.5 to 2% daily. Silver has been moving 3 to 4%. In thin holiday trading, these moves have accelerated. But this Monday is different. This Monday, Western traders return from Christmas break to discover that silver spent the holiday weekend trading $8 higher on the other side of the world. They'll log into their systems and see a price that doesn't match reality. They'll see positions that are suddenly dramatically underwater. Some analysts are predicting that silver could hit $100 per ounce in 2026. Based on current supply-demand fundamentals, that's not speculation, it's arithmetic. If industrial demand stays at 700 million ounces, if investment demand increases even modestly, if supply continues to fall short, the math simply doesn't work at current prices. What this means for you. If you own physical silver, actual coins, actual bars sitting in your possession or in allocated storage, you're holding one of the scarcest monetary assets on Earth. At the exact moment its scarcity is being discovered by global markets. If you own paper silver, ETFs, unallocated accounts, futures contracts, you need to understand that you might not own what you think you own. You own a claim on silver. You own a promise. And promises are only as good as the entity making them and their ability to deliver. The divergence between paper and physical pricing is the market's way of telling you that physical is real and paper is increasingly questionable. The Monday gap will be historic not because of the dollar amount, $8, $10, $15, whatever it ends up being. It will be historic because it's the moment the world realizes the price suppression era is over. The moment when physical reality overwhelms paper fiction. The moment when decades of fractional reserve precious metals banking collides with actual industrial shortage. The bigger picture gold hit its 50th record close this year. Silver surged above $70 and is now pushing toward levels that seemed impossible just months ago. Meanwhile, Bitcoin, often marketed as digital gold, has spent recent weeks moving sideways. down roughly 7% year to date after peaking above $120,000 in October. During the same period, gold futures rose about 13% and silver futures soared 51%. When physical scarcity dominates the narrative, investors choose real assets over digital promises. They choose metal over code. They choose silver over speculation. The weekend is over. Monday is here. The gap will be historic. The question isn't whether it will happen. It's already happening right now in Shanghai. The question is how Western markets will react when they open their eyes Monday morning and realize the game has fundamentally changed. Will they acknowledge reality or fight it? Will they close the gap or try to maintain the fiction? Either way, this is the week we'll look back on as the moment silver broke free, the moment the paper market lost control, the moment China's physical demand overwhelmed the West's paper supply. $80 in China, $71 in America, an $8 gap that can't be arbitraged because there isn't enough metal to arbitrage it. Historic doesn't begin to describe what Monday will bring. Are you ready?